Donald Trump hits Taiwan, India and New Zealand with higher than expected tariffs. US jobs figures were weaker than expected, and bets the Fed will cut next month have firmed. That's coming up in our 5 Things in 5 Minutes on Monday, August the 4th. And in our deep dive interview, ANZ Head of Asia Research, Khoon looks at the winners and losers from Friday's big tariff news.
Ultimately, the global consumer will probably end up having to eat some of the negative repercussions from the higher tariffs at some point.
But first, in 5 and 5 with ANZ, US non-farm payrolls rose 74,000 in July, which was less than the 110,000 consensus of economists' forecasts. But it was the downward revisions of 250,000 jobs in total in May and June that was the surprise, says ANZ economist in London, Bansi Madhavani.
Now the 3-month moving average of the payroll growth has slowed to little over 35,000 in July, and that compares to 231,000 at the start of the year. So such a report does raise concern about downside risks to the labor market. The question for the FOMC now is whether they can risk maintaining a modestly restrictive policy if there are signs of further labor market weakness.
As of 4 a.m. Sydney-Melbourne time, the markets were closed with the S&P 500 ending down 1.6% and the Nasdaq fell 2.2% on all of that tariff news. The US 10-year Treasury yield fell 14 basis points to 4.22%. The big mover was the US 2-year Treasury yield, which fell 25 basis points to 3.70%. Gold rose 1.5% with those lower US interest rates to $3,414 an ounce, while West Texas oil futures fell 2.8% to $67.13 US a barrel. Now that was before OPEC Plus announced over the weekend another 547,000 barrels of extra production. The US dollar index fell 0.8% on those lower interest rates. The Aussie dollar rose the same amount, 0.8% to 64.77 US cents. But the Kiwi rose only by 0.4% to 59.17 US cents. More on that later. Number 2, Bansi says the weak jobs figures have increased market expectations. The Fed will cut again next month.
Our baseline view remains that the Fed will find it appropriate to resume cutting rates at its September meeting. Financial markets are also moving in that direction. Following the weak July labor market report, the US dollar sold off and Treasury yields fell. Markets are now pricing over 82% odds of a 25 basis point rate cut at the September meeting, and that compares to under 40% odds priced just a few days ago.
Number 3, the big tariff news on Friday is expected to slow economic growth in Asia, but not just yet, says ANZ Head of Asia Research, Khoon.
The full brunt of the latest tariff impacts will really only be felt probably over the course of 2026. That's because, once the front-loading activity wanes and the tariff impact starts to weigh on growth and consumer spending in the US, that's when we start to see growth levels start to slow down. I think most of that would be apparent in 2026 rather than in 2025.
Number 4. One of the surprises on Friday was New Zealand getting a 15% tariff rate, which was up from the 10% indicated on Liberation Day on April the 1st. The key thing was that Australia's tariff rate stayed at 10%, says ANZ New Zealand Chief Economist Sharon Zollner.
At the end of the day, we only sell 12 or 13% of our goods exports to the US. The majority of that is dairy and meat, beef in particular, and the prices for those are currently excellent. Wine is a bit more exposed. We thought we might have an offsetting competitive advantage versus the EU and no worse than Australia, but isn't the way it's panned out. So I think it will certainly cause a bit of stress in that sector. But for New Zealand as a whole, this is probably quite manageable in terms of the direct impacts. The impacts on confidence and on China are probably of greater concern potentially.
Number 5. Also in New Zealand, consumer confidence fell again in July, as measured by the ANZ Roy Morgan survey. Inflation expectations also rose to 5.1%, the highest level since April 2023. Here's Sharon again.
It is quite something that consumer inflation expectations have gone back up above 5%, which doesn't sit well with the firm's expectation that they're going to be raising wages by about 2.5%. It's literally half the rate that consumers feel that they need to not be going backwards, even though those numbers are nothing like our actual forecasts for real wages. Perceptions do matter, so we're seeing that consumers are generally being very, very cautious with their spending. That's a trend we'd expect to continue for some time. So we expect that the Reserve Bank will ultimately choose to ease the official cash rate more than they are currently expecting, just to shore up the economy a little bit.
Sharon Zollner there. Now, in our deep dive interview, ANZ Head of Asia Research, Khoon analyses the winners and losers from the big tariff list issued by Donald Trump on Friday.
Most of the rate for Southeast Asia ended up around 19 to 20%, which had been previously announced earlier. The big surprise really was Taiwan and India, which President Trump had earlier earmarked a 25% tariff. And for Taiwan, they got 20%, which is higher than the negotiated rate that Japan and South Korea achieved. So that was a surprise and would be disappointing to the Taiwanese negotiators. But Taiwanese President William Lai indicated that 20% tariff rate could be temporary, and they're still working hard to try and get a lower rate. In the event, it looks like what we are settling in is a tariff regime of between 15 to 20% for most of the major Asian economies. And that's a rate which I think will be, while it's not ideal, it's not disastrous. And at least now it gives businesses and policymakers greater certainty in terms of where the tariff landscape lies. And businesses will be able to start making longer term decisions based on that.
Those levels around 20% and the levels set for India, are they likely to significantly reduce export volumes from those countries into the United States? Because there must be a threshold beyond which it just doesn't make sense.
Well, you have to remember that the comparison is not to a zero tariff level, because right now there is a minimum baseline tariff of 10%. And most of the major economies have tariff levels of around 15%. For example, the EU and Japan have 15% tariff levels. So that should be the level of comparison. So if you're at 20%, it's only a 5 percentage point differential. And if you have other cost advantages, such as lower labor costs or efficient transportation systems, then that still makes that particular economy attractive to continue to manufacture and source into the US from there. India is a tricky one because at 25%, that's a bigger gap. And companies that have been thinking of shifting production to India might start to do their maths again in comparison to other countries that have the lower rate.
Perhaps surprising given the strength of trade and relationships. What do you make of that number and whether it might change?
I think there's still a possibility that the rate for Taiwan could go down towards the 15% level that South Korea and Japan managed to achieve. I suspect perhaps President Trump was not satisfied with what Taiwan had offered. After all, if you look at the agreement between US and Japan and with South Korea, both Japan and South Korea made commitments of significant investments into the United States. For Japan, it's $550 billion US dollars. For South Korea, it's $350 billion US dollars of investments on top of commitments of significant purchases of US energy and other products. So that sort of becomes like quite a high hurdle rate, and I think that's something that Taiwan probably would need to consider offering in order to achieve that 15% level. But having said that, the headline rate of 20% for Taiwan does look like it might put them at a disadvantage, but huge bulk of Taiwan's exports to the US are semiconductors, and at this stage, semiconductors are exempt from the reciprocal tariffs. So the actual hit to overall Taiwan's exports at this stage is actually not as bad as it seems.
Khoon there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, August the 4th. Catch you tomorrow with analysis of China's trade deal negotiations with the United States. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.